Good evening. Please come to next paragraph. Non-controlling interest in the acquiree. Question number 24 we have done. Yes, yesterday. Last problem. So now non-controlling interest we have already discussed. It is that portion of the subsidiary equity which is not wholly owned by the parent company. So the balancing figure is called NCI. NCI can be measured either at fair value or proportionate share in the net asset. We have seen this formula also. If it is to be measured at fair value, take the number of share multiplied by market price. If it is based on proportionate share in net asset, take percentage into acquisition date fair value of net asset. Fair value of net asset is fair value of all identified asset minus fair value of all identified liabilities. Or you can take share capital plus reserve and plus the adjustment on the acquisition. Okay. Now solve this question number 38. Company A acquired, this was already discussed with you. Company A acquired 90% of the equity interest in B on 1st April 2010 for a consideration of rupees 85 in distress sale. Company B did not have any instrument recognized in equity. Company appointed a registered valuer with whose assistance the company valued the fair value of NCI and the fair value identifiable net asset at rupees 15 crore and rupees 100 crore respectively. Required find the value at which NCI has to be shown in the financial statement. At what amount NCI will be shown in the financial statement? There are two options. One is fair value method, under which the answer will be 15 crore, and the other will be net asset method. So net asset is 100 crore, NCI share is 10%, so the answer would be 10 crore. Write down option 1. Measure NCI at fair value. Measure NCI at fair value. That is rupees 15 crore. That is rupees 15 crore as derived by the valuer. That is rupees 15 crore as derived by the valuer. Option 2, write down. Measure NCI as proportion of fair value of identifiable net asset, fair value of identifiable net asset, that is rupees 10 crore. That is rupees 10 crore. 10% of 100 crore. 10% of 100 crore. Come to question number 25. Question 25 in the theory part only. On 1st April 2019, which company buys 80% share for rupees 20,000 of Dish Company? Details of Dish Company on 31st March 2019 are: ordinary shares 20,000, retained earning 2,000. Fair value of NCI is 5,000. Account for the acquisition for which company applying both the methods of NCI. Both the methods of NCI means first I will take fair value and I will take proportionate share in net asset. So write down option 1. Option 1, NCI at fair value. Or you can draw two columns to save time, okay? In the column you can write NCI at fair value, and one column you will draw NCI at proportionate share in net asset. Proportionate share in net asset. Two columns you will draw NCI at proportionate share in net asset, NCI at fair value. First write down A, consideration transferred. Consideration transferred is how much? 20,000. 20,000. Then B, write down NCI. B, write down, just write down NCI. In the fair value column write 5,000. And in the proportionate share in net asset column write 20% of 22,000. Share capital plus retained earning 22,000 into 20%, 4400. Point C, write down less fair value of identifiable net asset. Less fair value of identifiable net asset 22,000, 22,000. Right? Then write down goodwill. Goodwill in proportionate share in net asset column 2400, and in fair value column goodwill is 3,000. Is it right? Then you write one note. In fair value method, goodwill relating to NCI is equal to 20% of 3,000. 20% of 3,000 equal to 600. Okay? And then write down one more note. In proportionate share in net asset method, goodwill is attributable only to the parent. Goodwill is attributable only to the parent. Goodwill is attributable only to the parent. Come to question number 26. Below 26 number, easy problem again. Maryplex acquires 75% shares of Barnett for $140 million. Identifiable assets are measured at $250 million. Liabilities are assumed at $50 million. The valuer appointed by Maryplex determines the fair value of the 25% NCI as $42 million. Calculate goodwill by both the methods. So again write down calculation of goodwill oblique gain on bargain purchase. Calculation of goodwill oblique gain on bargain purchase. Right hand side you draw two columns. Proportionate share in net asset and fair value method. Okay. So that will save your time. First point A, write down. Point A, consideration transferred 140, 140. Point B, write down NCI. In case of proportionate share in net asset method, you will write 200 into 25%. How much is that? 50. And in fair value column write 42. 42. Then write down less fair value of net asset 200. 200. Therefore gain on bargain purchase. This time we have a gain on bargain purchase. There is a negative answer. Is it 10 in the first column? 18 in the second column. Okay. 10 and 18. Is right 10 and 18? Okay. Now you come to Question number 29. Question number 29. X Limited acquired the business of Y Limited, comprising of all assets and liabilities except cash. Asset of the acquiree comprise of tangible fixed asset 100 million, intangible asset 10 million, inventory 30 million, trade receivable 30 million, trade payable 30 million, loan 40 million. Underline, trade receivable include an amount of rupees 10 million due from X Limited. So this is pre-existing relationship. Okay. So out of total consideration paid, 10 will be treated as received for settling the trade receivable. X Limited pays 130 million as purchase consideration. Fair value of the assets and liabilities: tangible fixed asset 130, intangible asset 12, inventory 25, trade receivable excluding amount due from X Limited 18 million, trade payable 30 million, loan 40 million. The tax base for tangible and intangible assets are 80 million and intangible asset 5 million respectively. Assume for tax purpose the tax base of the acquiree will apply. Tax benefit will be available on write down of inventories and trade receivable of the acquiree when actually expensed. DTA or DTL are measured using effective tax rate of 25%. So we'll calculate the DTA, DTL also if there is a difference between carrying amount and fair value. X Limited agrees to pay Managing Director of Y a salary of 10 million per annum during the post-acquisition period for a term of 1 year to oversee smooth merger of the business of Y Limited along with business of X Limited. So is this 10 million part of purchase consideration or remuneration? No, it is remuneration because it is for looking after the business after the merger. Agrees to pay MD of Y a salary of 10 million during the post acquisition period for a term of 1 year to oversee smooth merger of business of Y Limited along with business of X Limited. So this is a compensation for future service provided. It is proposed to include this obligation as part of business. It is wrong. You can't do it. Is it right? So you should write a comment that this 10 million will not form part of business combination. This is what they are proposing. We will not agree to this. We will treat it as a separate transaction. Show accounting entry for business combination. So first what I'll do, this total PC 130 million, we will divide into 3 parts. First is for settlement of pre-existing relationship 10. Write down total PC 130, divide into 3 parts. Towards amount due from X 10, towards amount due from X 10, towards salary of 10 million per annum to MD of Y. This will be treated as salary, advance salary paid. And then remaining amount 110 will be treated as consideration for business combination. Total is 130 minus 10 minus 10. 110 is purchase consideration. Now in this question, because tax rate is also given and they have specifically asked you to calculate DTA or DTL, I'll prepare one more working note. Step 2, write down DTA or DTL. DTA or DTL, right? Amount in million. Right hand side 4 columns: accounting base, tax base, difference, DTA in bracket DTL. So if the answer is negative, it means it is deferred tax liability. And write down these 4 assets which we have taken over. 4 assets on which there is difference. Tangible fixed asset, intangible asset, inventories, trade receivable. These are the 4 items whose fair value is different from tax base. So first let us solve one by one. Tangible asset accounting base will be fair value 130. Tax base is 80 million. Tax base is 80 million. Difference is 50. Difference is 50. So this difference will give rise to deferred tax liability because tax base is lower. 50 multiplied by tax rate 25%, 12.50 DTL. And then intangible asset. Intangible asset accounting base will be fair value. Fair value 12 million. Tax base is given 5. Tax base is 5. Again difference 7 will give rise to DTL into 25%, 1.75. Inventory tax base will be fair value, accounting base will be fair value 25. Tax base will be book value 30. Difference 5. This time it will give rise to DTA because tax base of inventory is more. 1.25. Write trade receivable. Accounting base is fair value. $18 tax base 20. 2 difference 0.50. So the net will be DTL of 12.50. Negative is more. So we'll recognize a deferred tax liability. We will recognize a deferred tax liability also. So while passing the journal entry, keep in mind we have to also incorporate deferred tax liability. Right. Tangible fixed asset account debit journal entries all at fair value. Fair value of tangible fixed asset, paragraph number 3 from the top. Keep paragraph 3 in front of you. Tangible fixed asset account debit 130. Intangible asset account debit 12. Intangible asset account debit 12. Inventories account debit 25. Inventories account debit 25. Trade receivable 18, excluding amount due from this company. That other amount will settle separately. One line blank. Keep one line blank. To trade payable 30. To trade payable 30. To loan account 40. To loan 40. To deferred tax liability 12.5. To deferred tax liability 12.5. To bank account 110 only, as per the first step. Now check whether we have a difference. So there is a difference on the debit side. Goodwill account debit 7.50 is right. Goodwill account debit 7.50. Balancing figure, one line blank. Next entry, trade payable account debit to bank 1010. For X limited, Y limited is a liability, trade payable. So that liability is settled separately, trade payable to bank. And another 10 million paid to the managing director, which we will treat as advance salary. So third entry, write down advance salary account debit to bank account. Advance salary account debit to bank account 1010. Advance salary account debit to bank account 1010. Okay. Now quickly come to question number 39. Any query? You want to write narration also? Or you will write as homework? Homework. Oh, wonderful. Question number 39. Company A acquires 70% of Company S on 1st January 20x1 for consideration transferred of rupees 5 million. Company A intends to recognize NCI at proportionate share of fair value of identifiable net asset. With the assistance of a suitably qualified valuation professional, A measures the identifiable net asset of B at rupees 10 million. Okay. A performs a review and determines that the business combination did not include any transaction that should be accounted for separately from business combination. Required state whether the procedure followed by A and the resulting measurements are appropriate or not. And second, also calculate the bargain purchase gain in the process. So whether A Limited has followed the correct procedure or not. Huh? That did not include any transaction that should be accounted for separately from business combination. See what they are trying to say. If you calculate and find that you are getting a bargain purchase, then you should review the entire procedure again, and that is what they have done. And after doing that, they have concluded that we have recorded all transactions that should be recorded, nothing is left out, which means the procedure followed by them is right. So write down first paragraph. Because you are getting a gain on bargain purchase, one should check every figure again and ensure that all assets, liabilities, NCI, etc. are properly valued. The amount of, write the answer, important question. The amount of B's identifiable net asset. The amount of B's identifiable net asset exceeds the fair value of the consideration transferred. Exceeds the fair value of the consideration transferred. Plus the fair value of NCI. Plus the fair value of NCI. In B, resulting in an initial indication of a gain, on a bargain purchase. Resulting in an initial indication of a gain on a bargain purchase. Accordingly, A reviews the procedures. It used to identify and measure the identifiable net assets acquired. To identify and measure the identifiable net asset acquired, correct? Then to measure the fair value of both the NCI and the consideration transferred, and to measure fair value of both the NCI and the consideration transferred, comma, and to identify transactions that were not part of business combination, and to identify transactions that were not part of business combination. Following that review, A concludes that the procedures followed and the resulting measurements were appropriate. Procedures followed and the resulting measurements were appropriate. Okay. So that is your first question, whether the procedure followed is correct. Now write down gain on bargain purchase. So you have to also find out gain on bargain purchase, right hand side, rupees in million. Point number A, identifiable net assets. Point number A, identifiable net assets 10 given. Point B, less consideration transferred 5. And point C, less NCI 10 million into 30%. Proportionate share in net asset. 10 million is the net asset into 30%. 3. Therefore, gain on bargain purchase, GOBP 2 is right. Any query on that? Okay, come to 37 number. This is not 37, 36. Come to 36 number. Question 36. Company A and B are in power business. Company A holds 25% of equity share of Company B. On 1st November, Company A obtains control of Company B when it acquires a further 65% of the Company B share. So 25 plus 65, thereby resulting in a total holding of 90%. The acquisition had the following features. Consideration. Company A transfer cash of rupees 59 lakh plus issues 1 lakh share on 1st November. Market price of share on the date of issue is rupees 10 per share. The equity share issued as per this transaction will comprise 5% of the post-acquisition equity capital of Company A. Contingent consideration. Company A agrees to pay additional consideration of 7 lakh if the cumulative profit of Company B exceeds rupees 70 lakh over the next 2 years. At the acquisition date, it is not considered probable that extra consideration will be paid. The fair value of the contingent consideration is 3 lakh. So for us 3 lakh rupees is relevant. It is the fair value. Transaction cost is 1 lakh. Ignore. NCI, fair value of NCI is 7,50,000. Company A elects to measure NCI at fair value. So take 7,50,000. Previously held NCI. Company A owned 25% of the shares of Company B for several years. On 1st November, the investment is included in Company A's consolidated statement of financial position at 6 lakh using the equity method. That means they have applied IS 28. Carrying amount is appearing 6 lakh. But the fair value of this 25% stake today is how much now? 20 lakh. So which figure we will take? Fair value we will take. Fair value of Company B's identifiable asset is 60 lakh. Determine the accounting under acquisition method for business combination by Company A. First we will calculate goodwill. Add three numbers. Consideration paid for 60% share, fair value of previously held equity interest, fair value of NCI, and compare that with net identifiable asset. Difference if positive is goodwill, if negative is gain on bargain purchase. Now first you have to make a small list of consideration paid. So write down the heading, calculation of goodwill. Right hand side rupees, point number A. Cash consideration. Just write cash, 59 lakh. B write equity share issued, 1 lakh into 10 lakh. And then write contingent consideration at fair value. Contingent consideration at fair value. Is it 3 lakh? Contingent consideration at fair value 3 lakh. So this A, B, C will give you the consideration paid for new lot. Add fair value of previously held equity interest. Add fair value of previously held equity interest. How much? 20 lakh. Add NCI at fair value. Given 7,50,000 less fair value of identifiable asset. Let fair value of INA. Fair value of INA 60 lakh. So what is the net effect of this calculation? Goodwill 39,50,000. Check the answer. Is goodwill 39,50,000? Write one note below. Note. The acquisition cost of rupees 1 lakh. The acquisition cost of rupees 1 lakh should be recognized in profit and loss account. The acquisition cost of rupees 1 lakh should be recognized in profit and loss account. Okay. So today we are solving all these small simple examples. Come to question number 34. Just check, is it 34? Yes. A Limited has issued equity share capital of rupees 100 million. On 1/4/15, H Limited acquired 60 million shares of A Limited from its shareholders by issuing 2 million shares at the rate of rupees 800 each. Market price of the share is 27.50 per share. Fair value of identifiable assets and liabilities of A Limited are 3,000 million and 500 million respectively. Based on the above information, H Limited wishes to recognize a goodwill of 100 million. advise the company. Now, they want to recognize a goodwill of 100 million. But do you agree? No. So you calculate yourself and suggest. So write down calculation of goodwill. Calculation of goodwill. How many shares they have acquired? 60 million at market rate of 27.50. So multiply 60 million at the rate of 27.50. Calculate how much is that? 1650. Add non-controlling interest. Now there are two answers for non-controlling interest. One is you can take the fair value of net asset, and second you can take the market value of the share. Is it right? So what you do, you draw two columns here. One column fair value method, second proportionate share in net asset. Proportionate share in net asset. So proportionate share in net asset is 1000 and fair value will be 40 into 27.50. How much is that? 1100. Okay. Then you write down next. Fair value of net asset 2500. 3000 minus 500. 2500. Therefore, goodwill in the first column, is it 150? And in the second column, 250. Second column 250. Write a note. It is assumed that the fair value of shares of A Limited, is more clearly evident. Fair value of shares of A Limited is more clearly evident. Otherwise, this could have one more answer. You can take fair value of share issue 2 million into 800. So then it becomes 1600. And then by this method, the answer 100 would be right. Now come to 40 number. In your book, this is question number 40. By mistake, I have written 50 there. Question number 40. Prince Limited holds 30% shares in Crown Limited, which was acquired on 15th July 2014. In separate financial statement, the investment in associate is carried at cost rupees 200 million. In the CFS on 31st March 2017, investment is recognized applying equity method accounting to rupees 300 million, inclusive of goodwill of rupees 15 million. Accretion to the cost was partly recognized as a share of profit in the profit and loss account amounting to 80 million and balance 20 million in OCI. So first we'll explain this. 200 is the cost, and under equity method it is 300. Increase of 100 is due to share in post acquisition profit 80 and share in post acquisition OCI 20. So which means if the associate makes profit, we recognize our share in profit and loss. If the associate shows OCI, we recognize our share in OCI. Okay, that is the meaning of this line. And how much share we are holding right now? 30%. On 1st April 17, Prince Limited acquired another 30% stake of Crown Limited for rupees 350 million. So now we have 30 plus 30, 60%. As on the acquisition date, the fair value of the identifiable assets and liabilities of Crown Limited were determined as rupees 1200 million and 200 million respectively, which means the net asset is 1000 million. DTL has been reassessed based on the acquisition date fair value of assets and liabilities at rupees 40 million. So this figure they have given to us. No problem. Market price of previously held 30% interest is 330 million now. So this I will use for calculation. How should Prince Limited recognize the acquisition of controlling stake in Crown Limited? So we have to find out how much is goodwill or capital reserve. We already hold 30%, fair value is 330. We have acquired another 30% stake, fair value is 350. And we will calculate the NCI, whose share is now 40%. And we'll also incorporate the DTL in our calculation. Is it right? Write down calculation of goodwill. Calculation of goodwill. Consideration paid which you have purchased just now, 30% share, 30% stake, 350. Then we add fair value of previously held equity interest. Add fair value of previously held equity interest, 330. Add NCI into bracket based on proportionate share in net asset. NCI can have always two answers. You can either base it on the basis of fair value or you can base it on the basis of net asset. 40% into 1200 minus 200, 400. Then write down less fair value of identifiable net asset. Fair value of identifiable net asset. $1,000. Difference 80, and you have to also write down add deferred tax liability. $40. Therefore goodwill 120. Therefore goodwill 120. Now write down journal entry. In journal entry, based on the previous working note, you have to incorporate goodwill and deferred tax liability also, and non-controlling interest also. And you will de-recognize the previously held equity interest. Is it right? That you have to de-recognize. Treat that also as a form of consideration paid. So write down asset account debit 1200. Asset will come in. Goodwill account debit 120. To liabilities 200. Asset you will debit, liabilities credit, goodwill debit. DTL to DTL 40 and to investment in associate, how much is the book value on the date you have acquired additional share? 300. And how much is the fair value? 330. So the difference 30 we will treat it as fair value gain, and this will be transferred to profit and loss. Then write down to bank 350. This is the consideration paid, and to NCI 400. Now only cross check is whether this total is telling. Tallied. Then you write one more note that the balance of OCI rupees 20 million will be transferred to other component of equity. Other component of equity. Okay, now we'll come back to theory part. Some theory we'll discuss, and then we'll take some more questions. Subsequent measurement and accounting. What we have learned so far on the day one, how the accounting will be done. Subsequent measurement means after accounting, in the next reporting date, what will you do for certain items? Okay, some special item we will again discuss. An acquirer shall subsequently measure and account for asset acquired, liabilities assumed or incurred, and equity instrument issued in a business combination in accordance with other applicable IFRS, or those items depending on their nature. So this standard does not talk much about subsequent accounting. If you have acquired tangible asset, applied PPE. If you have acquired intangible asset, apply IS 38, like this. If you have acquired inventory, apply IS 2. But for some specific items, there is a guidance given by IFRS 3. So which are these items? IFRS 3 provides guidance on subsequent measurement and accounting for the following assets acquired, liabilities assumed or incurred, and equity instrument issued in business combination. So there are some guidance given on reacquired rights, contingent liabilities, indemnification asset, and contingent consideration. So first you see written below reacquired rights. We have discussed earlier, reacquired rights means a right given to the previous the acquiree. Rights given to acquiree, like franchise right, brands, trademark. But since you have acquired that entity, you will reacquire those rights. Reacquired rights will be recognized as an intangible asset and will be amortized over the remaining contractual period of the contract in which the right was granted. So reacquired rights will be written off over the remaining contractual period. In case if you sell the reacquired rights, you may sell it also. If you sell it, the difference between the sale value and carrying amount will be shown as gain or loss in P&L account. So it will be recognized as intangible, amortized over remaining period. In case of sale, profit or loss, transferred to P&L account. What about contingent liability? Can we recognize contingent liability in a business combination? Say yes. Yes, if three conditions are satisfied. There is a present obligation, past event, and fair value can be measured reliably. Once you have recognized it, then on the subsequent reporting date, you will record it at higher of the following two. Which higher of the following two? Amount that would be recognized in accordance with IS 37. IS 37 is provision, contingent liability and contingent asset. So apply the measurement principle of IS 37. Apply the measurement principle of IS 37 and see what amount we would have recognized. Okay, or the amount initially recognized, what we recognize on day one, if appropriate, less if appropriate the cumulative amount of income recognized in accordance with principles of IFRS 15. So initial amount recognized minus, if applicable, amount which have been already recognized as income in the P&L account, that you deduct. You'll get the balance. Compare these two numbers, take higher of the two, and the higher of the two will be recognized in subsequent accounting. Any difference transfer to P&L account. Okay. Next is indemnification asset. Do you remember indemnification asset? What is indemnification asset? In case if we have acquired the other company, we may be given some assurance, guarantee, that in case if you suffer loss, or in case if you suffer loss above a certain amount, then the acquiree will compensate the acquirer and it will be recognized as indemnification asset. So that day we recognized it. Now subsequently what I will do with this item? At the end of each subsequent reporting period, the acquirer shall measure an indemnification asset that was recognized at the acquisition date on the same basis as the indemnified liability or asset, subject to any contractual limitation on its amount. Again they are saying the same thing. This will be remeasured using the same basis as you have recognized indemnified liability or asset. Okay. For an indemnification asset that is not subsequently measured at its fair value, those indemnification assets which are not required to be measured at fair value, management's assessment of the collectibility of the indemnification asset. That means management will check how much amount can be recovered. Because whenever you have an asset, you have to check the recoverability and accordingly you value it. For those assets which are not measured at fair value. Those assets which are measured at fair value, you will measure at fair value. Those which are not measured at fair value, you will check management assessment of realizability, collectability and derecognition. Acquirer shall derecognize the indemnification asset only when either it collects the asset, sells the asset, or otherwise loses the right to it. So I have an asset. What all I can do with this asset? I will recover the amount. So when I will recover the amount, I will derecognize. Bank account debit to indemnification asset. Or I may sell it to another party. Or sometime I think that now this amount will not be recovered. Write it off. Derecognize. Next is contingent consideration. On this we have solved some examples also. Okay. Now, first of all, you have to see what is contingent consideration. Will it be settled in equity or will it be settled other than equity? If it is other than equity, then it can be settled in the form of a financial asset or a non-financial asset. Is it right? Accordingly, the subsequent accounting will change. Okay. Some changes in the fair value of contingent consideration that the acquirer recognizes after the acquisition date may be the result of additional information that the acquirer obtained after that date about facts and circumstances that existed at the acquisition date. So first point is that this is called measurement period adjustment. This is called, that means if I get some additional information about facts and circumstances that existed at the acquisition date, about the facts and circumstances that existed at the acquisition date, is it right? Then in that case, one effect will be in the carrying amount of contingent consideration and the second effect will be in goodwill. But if the change is due to events after the acquisition date, that means new facts and circumstances have arisen, it does not relate to situation on the acquisition date. Like for example, suppose after the acquisition date there was a target set for you, earning target, price target, reaching a milestone on a research and development project, and you have achieved such targets. Will it be called a measurement period adjustment or post combination adjustment? Post combination adjustment. This will not be adjusted in goodwill. Okay. Then where it will be adjusted depends on whether it is going to be treated as equity or other than equity. If it is other than equity, again we have to see whether it will be settled in the form of a financial asset or a non-financial asset. Okay. So 3 points are there on the screen. First, if contingent consideration is classified as equity, it will not be remeasured. It will not be remeasured, matter closed. Because equity instruments are not remeasured subsequently. If it is within the scope of IFRS 9, that means it is a financial instrument, then it will be measured at fair value. Change in fair value will be recognized in profit and loss account. And if it is not within the scope of IFRS 9, then also it will be measured at fair value and the change in fair value will be recognized in profit and loss account. So you will ask, then what is the difference? No difference. So anything other than equity, measure at fair value, change in fair value, transfer to P&L account. So for contingent consideration, let us summarize. Initially, it will be measured at fair value. And then it may be either classified as equity or others. If it is classified as equity, not subsequently remeasured, subsequent settlement is accounted for within the equity only. Even if it is settled, it will just move from one equity account to other equity account. Is it right? But if it is other contingent consideration, it may be within the scope of IFRS 9. Okay. Then measure at fair value, change in fair value, P&L account. Make correction in the diagram if the diagram is wrong in your book. And if it is not within the scope of IFRS, then also measure at fair value and change in fair value recognized in P&L account, right? come to one question. Check, is it 54? Is it question number 54? 54. ASF Limited acquired 60% shares of Y Limited on 1/4/2018. It agreed to pay rupees 10 lakh in cash, 30,000 equity shares of ASF Limited, whose fair value is rupees 85 per share. ASF Limited also agreed to pay deferred consideration of rupees 30 lakh after 3 years. In case Y Limited earned beyond certain limit, additional consideration will be paid at the end of the first year for rupees 5 lakh. Fair value of the contingent consideration is equal to rupees 1 lakh. So I will take 1 lakh right now, and then we will do the subsequent accounting. Rate of discount is 10%. ASF Limited follows cost method of IAS 27. Journalize entries for 3 years, assuming contingent consideration was paid. Fair value of the share of Y Limited was 150, 140, 190 on 31st March 19, 31st March 20 and 31st March 21 respectively. So first thing what you'll do, first thing you listen to me, this line says ASF follows cost method under IAS 27. So will this line is relevant or not? Not relevant, because I am not going to change the carrying amount in the separate financial statement. This IAS 27 is applicable to separate financial statement. Okay. So write down, first write down step 1, calculation of consideration for investment. Calculation of consideration for investment. Right hand side rupees. Right hand side rupees. Point number A. Cash. How much cash is paid? 10 lakh. Point B, write down fair value of shares. Fair value of shares. 30,000 into 85. 25 lakh 50,000. Is it right? Point C. Deferred consideration. Deferred consideration, right? 30 lakh into PV factor. 10%, 3 years. Is it 22 lakh 53,944 approximately? Then write down contingent consideration at fair value. Contingent consideration at fair value 1 lakh. Contingent consideration at fair value 1 lakh. Therefore, cost of investment. Therefore, cost of investment, add these 4 numbers, 59 lakh 3,944. Now in your question it is written past journal entries for 3 years. So first we will pass entry today for acquisition of investment, and then we'll pass entry for the finance cost on deferred consideration. Is it right? We have to pay 30 lakh, but I have recorded present value. So the every year will compute interest at 10%, and that will be treated as finance cost. And then we will also pass one entry for payment of contingent consideration. So dear student, write down in the books of ASF Limited, in the books of ASF Limited, journal entries. 1st April 2018, investment account debit 59,03,944, same amount. Investment account debit 59,03,944 to bank account 10 lakh, to equity share capital account 3 lakh, to equity share capital account 3 lakh, to securities premium 22,50,000. To securities premium will be 22,50,000. Yes or no? 30,000 share into 75. 30,000 into 75. To deferred consideration 22,53,944. 22,53,944. And to contingent consideration fair value 1 lakh. This is what we paid at the beginning. Being investment purchased. This is the entry number 1. Then we'll go to end of the year. We have recorded deferred consideration at present value. So every year 10% interest will be calculated on the opening balance. Entry number 2, 31st March 19. Finance cost account debit 2,25,394. How did you get it? Write in bracket 10% of 22,53,944 to deferred consideration account 225,394. Narration being finance cost on deferred consideration. Then the question says that assuming that contingent consideration was paid. Now the date they have not mentioned, just write a date there. Assuming that contingent consideration was paid on 31st March 2019. On 31st March 2019. In any case, it is only for 1 year. In case if you earn the target of certain profit, 5 lakh will be paid. So 1 year is over. So contingent consideration will be paid now. How much amount we had initially recognized? 1 lakh. How much amount we have recognized? 1 lakh. But we have to pay 5 lakh as we had committed to pay additional consideration of 5 lakh if some targets were achieved. So the difference between 5 lakh and 1 lakh, 4 lakh is my loss. Now this will be transferred to P&L account. It won't be adjusted in goodwill because this is based on events and circumstances after the acquisition date. It does not relate to condition existing on the acquisition date. Understood? Being contingent consideration paid. being contingent consideration paid. Now one line blank. This first year is over. Second year, 31st March 2020. Again we will calculate the interest on the opening balance. What will be the opening balance in the deferred consideration account now? 24,79,338 into 10%. Into 10%, 247,934. Make it 247,934. To deferred consideration account, 247,934. And in bracket write down finance cost P&L account. Otherwise you want to pass one more entry, then pass one more entry and transfer it to P&L account. Now come to 31st March 2021. 31st March 2021. What is the opening balance now? 27,272. But you should write such an amount. The total should become 30 lakh after this entry. Yes or no? Total should become 30 lakh after this entry. 272728 being finance cost. And now 3 years are over. One more thing you will do. What is that one more thing you will do? You will pay the deferred consideration. So now write down 31st March 2021. Deferred consideration account debit to bank account 30 lakh. Deferred consideration account debit to bank account 30 lakh. Being deferred consideration paid. Agreed? This is how the whole accounting is completed subsequently. And one more similar example we'll take. Right? Question number 55 now. Question number 55. On 1/4/2018, ASF Limited agreed to purchase 30,000 shares of A Limited from P Limited. Total number of shares of A Limited are 50,000. ASF Limited agreed to pay cash 50,000, 10 lakh after 3 years, land fair value 6 lakh. ASF Limited will issue own share 10,000, fair value 22, face value 10, discounting factor 10%. If profit of A Limited exceeded rupees 1 crore, then ASF Limited will pay rupees 8 lakh after 2 years. This time after 2 years. Fair value of the contingent consideration is 2 lakh. This 2 lakh I will take in the beginning for calculating cost of investment. Then fair value on 31st March 19 was 3 lakh. So I will increase it by 1 lakh. And 8 lakh. Again I will increase it by 5 lakh. And then this 8 lakh was paid on 31st March 2020. Journalize acquisition entry on 1/4/18 and prepare investment in A Limited account, contingent consideration account, deferred consideration account. Okay. Just write here in bracket in separate financial statement to avoid any doubt. In separate financial statement. This time instead of asking you to pass journal entry for 3 years, they've asked you to prepare the ledger accounts. Okay. So be ready for everything. So first you write down step 1, calculation of consideration paid or cost of investment. Cash paid 5 lakh. 50,000, sorry. In the question you make it 5 lakh. Fair value of shares 2,20,000. Fair value of shares 2,20,000. Then write down next point C. Deferred consideration 10 lakh into PV factor around 7,51,000. 315. Write that also if you want. Then write down contingent consideration fair value 2 lakh. Then write down land fair value 6 lakh. Take total according to your notebook. Tell me how much is the total. 22 lakh 71,000. 315. The student is saying 315 also. Write that also. Now we'll pass first initial journal entry and then ledger accounts. Is it right? So write down in the books of ASF Limited journal entry on acquisition. Journal entry on acquisition in separate financial statement. In separate financial statement. Investment account debit 22,71,000. If you've written 315, write that also. To cash and bank, write 5 lakh. To cash and bank 5 lakh. To equity share capital 1 lakh. In bracket write 10,000 into 10. To securities premium 10,000 into 12. 10,000 into 12. 1,20,000. To deferred consideration present value. To deferred consideration present value 7,51,000. 315. Very good. To contingent consideration. To contingent consideration 2 lakh. To land how much? 6 lakh. To land 6 lakh. Being investment purchased. Okay. And then they have asked you to prepare 3 accounts. So write down first account, investment in equity shares of A Limited account. Investment in equity shares of A Limited account. Then under that you draw this ledger account format. Have they given you any instruction about the method of accounting, cost method or fair value method? No. So you'll follow cost method. Only on day 1 you write the cost and subsequently carry forward the balances. So write down, same thing you copy again on the debit side. To bank account 5 lakh. To equity share capital account 1 lakh. To securities premium 1,20,000. To deferred consideration 7,51,000. If you want to write 315, right? To contingent consideration 2 lakh. To land 6 lakh. Written 6 items. Credit side, right, by balance carried down. Same total 22 lakh 71,000 or 22,71,315 as per your notebook. Step next, write down 1,419. To balance brought down, same figure. By balance carried down, same figure. Then 1,420,20. To balance brought down, same figure. By balance carried down, same figure. Right. Then you draw this account. Contingent consideration account. Contingent consideration account. Draw the format of ledger account first. You will do it as homework. Okay. So now we'll take a break. Complete the contingent consideration account and deferred consideration account. Okay.